Amazon just generated $181.5 billion in revenue, more than double its biggest rival, yet is quietly financing its future with massive debt. Why is Amazon borrowing billions while Microsoft internally funds the exact same artificial intelligence revolution? When you examine Amazon's staggering $119.1 billion debt load against Microsoft's shrinking $40.2 billion obligation, a terrifying picture emerges for fundamental analysis. Amazon posted an explosive $30.3 billion net income, seemingly matching Microsoft's flawless $31.8 billion quarterly profit. Net income is what remains after expenses are subtracted from total revenue. Wall Street cheers this 77% profit surge from Amazon and the 23% growth from Microsoft as a tied value investing race. Value investing involves picking stocks trading for less than their intrinsic value, but strip away Amazon's monstrous $16.8 billion paper gain from Anthropic, compared to Microsoft absorbing a tiny $14 million operational loss from OpenAI, and the winner changes. Amazon's headline profit is a precarious illusion, inflating earnings without generating cash, whereas Microsoft's organic growth represents ruthlessly efficient operational profitability. To grasp this divergence and what it means for your investing strategy, examine the sheer cost of corporate survival. Microsoft generated a robust $15.8 billion in quarterly free cash flow, while Amazon's trailing 12-month free cash flow collapsed to just $1.2 billion. Free cash flow represents the cash generated after supporting operations and maintaining capital assets. You might assume both titans possess infinite war chests to dominate stock market analysis headlines. Yet Amazon's cash flow plummeted 95% from last year, while Microsoft's operating cash flow safely represents 147% of its net income, providing an unshakable cash fortress. Amazon is bleeding cash to construct servers, leaving its financial flexibility paralyzed while Microsoft continues minting liquidity from its software dominance. The golden rule for your portfolio is that rapidly evaporating free cash flow is the ultimate leading indicator of internal distress, leaving vulnerable companies exposed to sudden market volatility. This brings us to the elephant in the room regarding cloud dominance. Microsoft expanded its already astronomical operating margin to 46.3%, while Amazon fiercely fought to reach a 13.1%. Operating margin measures how much profit a company makes on a single dollar of sales after paying for variable production costs. Bulls argue Amazon's margin expansion proves its retail efficiency is finally paying off. However, realizing Amazon needs $181.5 billion in total sales just to generate the same absolute profit as Microsoft's leaner $82.9 billion revenue engine reveals a glaring structural disadvantage. Microsoft exercises supreme pricing power, extracting brutal efficiency from every enterprise dollar, whereas Amazon must endlessly churn through low-margin retail volumes. For your portfolio, this divergence teaches that high-margin business models provide a critical margin of safety, insulating investments against inflation and supply disruptions. Once you grasp this, you will view stock market analysis in a completely new light. Beneath those margins, the battle for enterprise technology reveals another shocking contrast in structural stability. Amazon's AWS division accelerated to a 28% growth rate, yet Microsoft's Azure ecosystem is scaling faster at a blistering 40% clip. Mainstream investing strategy suggests AWS holds an insurmountable scale advantage. But Microsoft shatters that outdated narrative with its unprecedented $627 billion commercial remaining performance obligation, compared to Amazon's heavy reliance on a $25.7 billion shipping cost burden. Remaining performance obligation is essentially a massive backlog of locked-in, guaranteed future revenue contracts. That $627 billion backlog acts as an impenetrable shield of guaranteed enterprise revenue, rendering Microsoft nearly immune to economic fluctuations, while Amazon remains chained to physical logistics constraints. The implication here is that contracted recurring revenue pipelines are infinitely more valuable than transactional retail dominance during intense global uncertainty. Yet Amazon holds a hidden ace, explaining its terrifying spending spree and massive asset accumulation. Amazon is suffocating under a staggering $147.3 billion trailing capital expenditure burden, entirely dwarfing Microsoft's aggressive $78.2 billion 9-month infrastructure spend. Capital expenditures are funds used to acquire, upgrade and maintain physical assets. It looks like Amazon is recklessly burning capital to keep up with Azure. But inside that massive spend, Amazon quietly built a custom silicon business running at a $20 billion annual revenue rate, an area where Microsoft remains dependent on third-party hardware vendors. Amazon vertically integrates its supply chain to achieve total silicon independence, while Microsoft faces severe exposure to supply bottlenecks for advanced memory chips. What does this divergence mean for your positions? True value investing requires finding companies that completely control their foundational infrastructure, as this aggressively mitigates downstream supply chain risks. But this quest for silicon independence comes at a severe cost to you, the shareholder, seen directly in equity returns. Microsoft just showered its investors with $10.2 billion in dividends and repurchases this quarter, while Amazon returned exactly $0. You might think Amazon retaining all capital is the smartest path for extended compounding, but comparing Microsoft's stunning 33.5% annualized return on equity against Amazon's 28% return on equity, which is distorted by paper gains, reveals a stark reality. Return on equity measures core financial performance by dividing net income by shareholders' equity. Microsoft is orchestrating a masterclass in capital efficiency, internally funding the greatest technological leap while generously rewarding its owners, whereas Amazon halted buybacks out of pure financial necessity. Your fundamental analysis must prioritize companies that can finance hypergrowth without starving shareholders, because halting capital returns is often a desperate response to vanishing cash flows. This simple rule is incredibly powerful. We must also address the massive balance sheet expansions both companies are undertaking to dominate the future. Amazon just inflated its total assets to a massive $916 billion, while Microsoft expanded its total assets to a leaner $694 billion. At first glance, Amazon's sheer asset base seems to guarantee an impenetrable moat. But when examining Amazon's current ratio tightening to 1.18 compared to Microsoft's current ratio of 1.28, the immediate liquidity pressure on Amazon becomes glaringly obvious. The current ratio measures a company's ability to pay short-term obligations within 1 year. Amazon transforms every available dollar into physical warehouses and server farms, violently draining immediate liquidity, whereas Microsoft carefully balances artificial intelligence expansion with robust cash preservation. As an active market participant, this tells you that biggest does not always mean safest. Bloated asset bases often mask severe liquidity constraints that paralyze companies during sudden policy shifts. This liquidity constraint brings us directly to the underlying profitability of their core products, where a fascinating reversal is happening. Amazon improved its gross margin to 51.8%, while Microsoft saw its gross margin compressed to 67.6%. Gross margin simply represents the percent of total sales revenue retained after incurring direct production costs. Analysts look at Amazon's improvement and claim their synergies are finally catching up. But the complication arises when realizing Microsoft's margin drop is deliberately driven by massive depreciation costs of deploying its $37 billion artificial intelligence revenue run rate, whereas Amazon desperately relies on $110 billion in service sales just to stay afloat. Microsoft intentionally sacrifices a sliver of gross margin to absolutely dominate enterprise software, while Amazon is forced to squeeze pennies out of complex retail logistics. Finally, we must examine the Achilles heel of both empires to see who is truly invincible. Amazon's retail stores division surged with a 15% unit growth, while Microsoft's more personal computing segment stagnated with a 1% decline. Retail investors see Amazon's consumer strength as a beautiful diversification play against enterprise slowdowns. However, Amazon's consumer reliance forces them to borrow at historically high 4.5% interest rates just to fund data centers. while Microsoft is actively shedding consumer hardware to become a singularly focused artificial intelligence behemoth. Amazon is hopelessly trapped balancing a capital-intensive logistics empire against a software rivalry, while Microsoft surgically pivots its $38.4 billion operating income engine into high-margin corporate modernization compared to Amazon's $23.9 billion operating income. Operating income is the pure profit realized from operations after deducting daily operating expenses. As an active market participant, you must recognize that focusing on a high-margin, singular enterprise mission outperforms a fractured empire trying to subsidize logistics with cloud profits. So, why is Amazon quietly borrowing billions while Microsoft effortlessly internally funds the exact same artificial intelligence revolution? The definitive truth is that Amazon's reliance on debt to fund its AWS infrastructure creates massive scale, but introduces immediate, terrifying financial fragility. Microsoft's impenetrable $627 billion revenue shield and superior capital conversion prove that their organic profitability is vastly superior to Amazon's paper profit illusions. Microsoft wins this comparative battle by an absolute landslide. That is exactly why I believe that within the next 24 months, the technology sector will face a brutal margin reckoning, and companies financing artificial intelligence through debt rather than free cash flow will suffer catastrophic valuation collapses. But I want to hear your take. Does Amazon's massive infrastructure scale justify its heavy debt load, or is Microsoft the only safe bet in this cloud rivalry? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.